What would you do if you suddenly had $50,000 to invest? You could use it as a down payment on a rental property, or you could put the entire amount into a diversified stock market fund and let compound growth do the work. At first, real estate looks like the obvious winner. You can see the house, you can collect rent every month, and with a mortgage, your $50,000 can give you control over a property worth $250,000. Stocks seem almost boring by comparison. You transfer money into an account, buy a fund, and then wait. But here's the problem. Most comparisons between real estate and stocks leave out some of the most important numbers. They calculate rent, but forget repairs. They calculate stock returns, but forget investor behavior. They calculate investment returns, but completely ignore the value of your time. So let's put two investors in exactly the same starting position and follow them for 20 years. Call them Alex and Daniel. Both have $50,000 saved. Both earn roughly the same income. And both want to turn that $50,000 into long-term wealth. Alex chooses real estate. He uses the $50,000 as a 20% down payment on a $250,000 rental property. The remaining $200,000 comes from a mortgage. Daniel takes the same $50,000 and puts it into a broad stock market index fund. He also invests an additional $300 every month. Neither strategy is automatically better. The interesting part is what happens after we include everything. Let's start with Alex. The first thing he notices is leverage. His $50,000 doesn't buy a $50,000 asset. It gives him exposure to a $250,000 property. That's a huge difference. If the property appreciates, Alex benefits from the increase in the value of the entire property, not just his original $50,000, for example. If a $250,000 property rises 4%, that's a $10,000 increase in value. Alex didn't have to personally invest another $10,000 to get that exposure. This is one of real estate's biggest advantages. Leverage can dramatically increase the return on your own capital. Then there's rent. Suppose the property generates $1,800 a month. The mortgage payment might be around $1,300 depending on the loan terms. At first glance, Alex appears to have roughly $500 left over every month. That sounds fantastic, but that isn't profit. It's revenue minus one expense, and a rental property has plenty of other expenses. Property taxes, insurance, maintenance, vacancy, repairs, capital expenditures, and potentially property management. Imagine the water heater fails, then the roof needs work, then the tenant moves out. Suddenly, several months of apparently excellent cash flow can disappear. This is where many amateur real estate calculations go wrong. They look at rent minus mortgage and call the difference profit. But a rental property isn't a vending machine. The money coming in isn't the money you keep. You have to calculate the entire operating cost of the asset. And there's another expense that doesn't appear on a bank statement: your time. If Alex manages the property himself, he may have to answer tenant messages, arrange repairs, inspect the property, advertise vacancies, screen tenants, and deal with emergencies. He may not write himself a paycheck for those hours, but economically, those hours still have value. Meanwhile, Daniel is doing almost nothing. Daniel's investment looks much less exciting. He puts $50,000 into a diversified index fund. Then he automatically adds $300 every month. That's basically it. No tenant, no mortgage, no plumber, no leaking roof, no property inspection. But there's something powerful happening underneath the surface. Compounding. Suppose his portfolio averages around 10% annually over a very long period. That doesn't mean it will earn 10% every year. One year could be strongly positive, another could be negative, and sometimes the market can fall dramatically. But if Daniel stays invested for decades, his previous gains can begin generating gains of their own. That's the part people underestimate. In the beginning, compounding feels almost useless. A $50,000 portfolio earning 10% produces about $5,000 of growth in an average year, but eventually, the portfolio becomes large enough that the growth itself can become larger than the amount Daniel is personally contributing. The snowball gets bigger, and Daniel doesn't need to make dozens of decisions to keep it rolling. So who wins after 10 years? Now let's fast forward. After 10 years, Alex's property could be worth substantially more than the original $250,000 if the local market has appreciated. His mortgage balance has also fallen, so his equity could become a significant amount. But that number isn't the same thing as cash in his pocket. Selling the property can involve transaction costs, taxes depending on the situation, and potentially other expenses. And Alex has also had to deal with the property throughout those 10 years. Daniel's portfolio, meanwhile, has grown through a combination of market returns and his monthly contributions. And he can generally sell investments much more easily than Alex can sell a house. That's an important distinction. Real estate can be valuable without being liquid. You can't sell 7% of a bathroom because you need $10,000 tomorrow. With a diversified stock portfolio, accessing part of your investment is generally much easier. So at the 10-year mark, the question isn't simply, which one has the bigger number? You also have to ask, how much money did each investor contribute? How much debt did they take on? How much time did they spend? How much risk did they accept? How liquid is the investment? And what would happen if the assumptions changed? Then comes year 20. This is where compounding becomes much more interesting. Imagine Daniel continues investing $300 every month. Over 20 years, those contributions add up to $72,000. Combined with his original $50,000, he has personally invested $122,000. If the portfolio achieves strong long-term returns, the final value could be several times that amount. The difference comes from growth, not from Daniel finding the perfect stock, not from predicting the next crash, not from trading every week, simply from allowing capital to compound over a long period. Alex has a different path. After 2 decades, he could potentially own a property with substantial equity. If the property appreciates significantly and the mortgage is largely paid down, his equity could become several $100,000. And he may have collected rental income along the way. That sounds like an obvious victory for real estate. But again, we have to include the other side of the equation. Alex has paid interest, taxes, insurance, repairs, maintenance, vacancy costs, potential renovations, and possibly management expenses. The property may also have required hundreds of hours of his attention. So the real comparison isn't $250,000 house versus $50,000 of stocks. That's misleading. The real comparison is, what did each investor ultimately gain after considering capital, expenses, debt, taxes, risk, liquidity, and time? That's a much harder question. But stocks have a serious weakness too. It would be easy to turn this into a story where stocks are the effortless winner. That would also be misleading. Stocks can fall very quickly. Imagine watching a $200,000 portfolio suddenly become $140,000 during a major market decline. Nothing has physically broken. Nobody has called you about a leaking pipe. But emotionally, it can be brutal. And that's where investor behavior becomes one of the biggest risks. A diversified portfolio only works as intended if you can actually stay invested. If you panic during a crash, sell after prices have fallen, and then wait until everything feels safe before buying again, you can destroy the advantage of compounding. Real estate has a different psychological experience. Property prices don't update on your phone every second. Your house might technically fall in market value, but you're less likely to see a red number flashing in your brokerage account every morning. That doesn't make real estate safer. It simply makes the volatility less visible. The biggest weapon real estate has is leverage. There's one reason real estate can outperform in the right situation. Leverage. With $50,000, Alex controls a $250,000 asset. If the property appreciates, the increase applies to the larger asset, but leverage cuts both ways. If the property falls in value, Alex still owes the mortgage. And unlike a stock portfolio, he can't simply diversify a single house across thousands of businesses. He's concentrated in one property, one neighborhood, and potentially one local economy. That's why leverage should never be treated as free money. It's a tool. Used carefully, it can accelerate wealth creation. Used recklessly, it can accelerate losses. And real estate has another advantage. Real estate can generate income directly. A properly managed rental can produce cash flow while the owner potentially benefits from appreciation and mortgage principal reduction. There can also be tax advantages depending on the country, property structure, and investor's situation, but these advantages aren't universal. A bad property in a bad market doesn't magically become a great investment because it's real estate. The numbers have to work. You need enough rental income relative to the property's price. You need realistic assumptions for maintenance and vacancies. You need sufficient reserves for unexpected expenses, and you need to understand the financing. In other words, successful real estate investing often looks less like passive investing and more like running a small business. So which one should you choose? Here's the uncomfortable answer. There is no universal winner. If you want maximum simplicity, diversification, liquidity, and minimal day-to-day involvement, broad index investing has enormous advantages. You can start with relatively little money. You don't need to find tenants. You don't need to repair buildings. And you can spread your investment across many companies. But if you're comfortable with debt, understand your local property market, can manage the operational side, and find a property where the numbers genuinely work, real estate can be extremely powerful, especially when leverage is used responsibly. And you don't necessarily have to choose one. A person could invest in stocks while owning real estate. In fact, combining the two can create a very different financial strategy. Real estate can provide exposure to property, rental income, and leverage. Stocks can provide diversification, liquidity, and effortless compounding. The important thing isn't choosing the asset that sounds best on social media. It's understanding what you're actually getting for the money, risk, and time you're putting in. Because the biggest mistake isn't choosing stocks, and it isn't choosing real estate. The biggest mistake is comparing them using incomplete numbers. Don't compare rent to stock returns. Don't compare a home's appreciation to a portfolio balance. Calculate the whole picture. Purchase costs, financing, taxes, maintenance, vacancy, fees, contributions, investment returns, your time, your risk tolerance, and your ability to stay invested for decades. Once you include everything, the answer may be very different from what you expected. because the best investment isn't necessarily the one with the highest theoretical return. It's the one whose risks, workload costs, and potential rewards you can actually live with for the next 10 or 20 years. And that's the real math behind stocks versus real estate.